That's right, you're watching Africa Trade and Business. I'm Bronwyn Seaborn. In this episode, we take a look at Zimbabwe's economic outlook and the property market in South Africa. So let's jump straight into it. Well, South Africa's commercial property market is showing signs of resilience in the face of economic challenges. That's according to ABSA. Ntaleng Lechela spoke to Michael Mortimer, head of SA Coverage Commercial Property Finance at ABSA, and kicked off with a look at the challenges the sector faced in 2023. Here's that conversation.
It certainly has had some turbulence and experienced some turbulence over the past few years. COVID certainly being a significant contributor to that, and it impacted obviously the different sectors in very different ways. The office sector is still recovering from the impact of COVID, with the impact that we saw on vacancies, on the whole work from home dynamic, and the vacancy factors, that sort of pent-up vacancies that developed post the COVID period, which are still being absorbed. If you look at the office sector, there's quite a difference if you look at vacancies versus occupancies, because in certain instances you'll have buildings that on the face of it are 100% let, but not necessarily 100% occupied, in the sense that you've got leases that are still in place, but people are not necessarily in the building. So we expect that to still play out in the next few years as leases are renewed and leases come up for renewal, and people sort of start downscaling further to meet the reducing demand. So that sector is still bearing some of the impact of the COVID dynamic, but that is starting to play out over time. Retail, we've seen a good rebound in the last few years. Trading densities are back up in most instances at pre-COVID levels, and in some instances beyond, but also a strong drive towards convenience retail. There was a lot of talk about essential services during the COVID period, and that sort of convenience core retail offering has become very, very paramount, and those type of convenience assets are certainly in strong demand. That said, we saw some really good trading figures out of most of the retailers over the festive season, and a lot of the regionals and super regionals are also showing strong recovery. So that sector's coming back nicely. The industrial sector has for the number of years now been the darling of the sector. Strong drive for supply chain, good quality supply chain offerings in well-established industrial parks and good arterial routes. Again, that was a sector that didn't have the necessary oversupply that some of the other sectors did, so that sector doing really well. And then if you look at the residential market, also somewhat muted in the last few years due to the elevated interest rate environment, but still a sector that's performing really well and in a very stable manner, particularly in the affordable and mid-market band of the residential sector. There's still significant pent-up demand there, but a far more discerning buyer stroke tenant in that market as well. Again, the impact of COVID with work from home, with people becoming a lot more discerning in terms of their residential offering and what their expectation was, has led to, again, as I say, a lot more refinement in terms of the offering in that market, and really good value for money for your tenants and buyers. So as you said at the outset, showing strong resilience, notwithstanding these economic challenges. What we're seeing as well is strong focus on operational efficiency, given some of the infrastructural challenges that we continue to face in terms of cost of utilities going up. We're all aware of things like load shedding, just increasing rates and other utility charges attaching to the different assets. So high degree of keen operational efficiency that we're seeing on new developments to ensure that the long-term sustainability of those assets are intact.
Michael, let me just interrupt you there. There's been a big trend that's been playing out in the property sector, which has been some migration, where we've seen a lot of people move to coastal areas. Now, this has boosted some demand for residential property within those coastal areas. What's been playing out in the commercial property scene? Are we seeing the same kind of trend or uptick in demand within those coastal areas versus in Gauteng?
Yes, again, very sector specific and very node specific. So an interesting dynamic that again, I guess had its genesis in COVID was the semigration trend that we saw from, let's call it from Gauteng into the coastal regions. But sometimes I think we may overplay that, in the sense that these were people who were perhaps more economically migrant than others. So what we've seen is some significant flood of capital out of Gauteng into the coastal regions, but not necessarily massive volumes of the population, because, you know, if you look at Gauteng, it still remains the economic heartland of the country. Sort of salaried employees aren't that mobile in the sense that they can necessarily move that quickly to the coastal region. So what we've seen is in certain instances individuals moving to the coastal regions, but head offices still remaining in Gauteng. And as I say, that's why if you look in Gauteng, you'll see that mid-market residential demand still there, because those are your salaried employees are still based there. You've seen areas in Cape Town, as again in the residential market, some of the more affluent areas seeing significant growth and demand for their product, because that's the move of capital down to the Western Cape and the Garden Route regions. So it's an interesting one. It's not necessarily as straightforward as it seems, and that's why in our business it's really key for us to have people on the ground in the different areas who can respond to those market dynamics and the changing market conditions, and ensure that we're able to service those markets and our clients accordingly in the different regions. Definitely, though, we are seeing a greater, with the prevalence of work from home, more sort of migrant employees, if you want to, for want of a better term, where people will be sort of spending less time in the office, perhaps, you know, living in the coastal regions and traveling from time to time to head offices in Gauteng. So it's an interesting dynamic that's playing out, and as I say, it's one where each particular geography, each particular sector has its own unique characteristics that we need to be responsive to as properly financiers and supporting this market.
Michael, let's talk about the financing now. So we know that your clients are facing tough economic conditions. Now, what does your loan book look like? Are we seeing more clients take up funding to fund these assets and these developments within the property sector?
Yeah, our book is certainly in a very, very strong position and a very healthy state. Our loan loss ratio is well within the levels that we would expect it to be. So I think, you know, we've benefited from sustainable long-term funding practices. And I think similarly, you know, we've got a very discerning, very responsible client profile, where I think due to and I guess there's no substitute for experience, because, you know, a lot of clients who've lived through not only the COVID period, but if one went further back, things like the subprime crisis in 2008 and other market shifting episodes, you know, people come through those and build experience and build resilience. And what one does find is a focus in our business, which is far greater on the cash flow from the underlying asset and the sustainability of the cash flow, as opposed to simply what the value of the asset is and your lending rates against that value. What we have seen through the down cycles is how paramount the sustainability of the cash flows and the underlying liquidity in those assets. And similarly, our clients have got a keen appreciation of that as well. So, you know, we live and learn, and as a consequence, I think, of the experiences that we've gained over many years along with our clients, you know, we partner with them in a responsible manner, in a manner that the structures we put in place are both sustainable and manageable from their point of view as well as ours. So at the moment, the book is performing really, really well, I'm happy to say.
Shifting focus to Zimbabwe, the country's growth outlook has dimmed. Consulting group Mark & Associates expects GDP to ease to 3.5% this year, as the southern African nation grapples with economic uncertainty amid agricultural headwinds and a cryptic business environment. Batanai Matsika, the Director of Insights and Research at Mark & Associates, elaborated on that forecast. Let's take a look.
So you find that for a country like Zimbabwe, given the global headwinds and some of the country-specific issues, you find that there's been a lot of changes, especially around the fiscus and even the monetary policy. I think in November, we put out a report around the budget itself, where there was an increase in taxes, in fees, and the like. So that has created an environment of uncertainty, especially when you then consider that Zimbabwe still remains on the low side, just looking at the structure of the economy and the presence of SMEs and the like. So there's been a lot of changes around tax regulations, because the way we look at it, the government itself in terms of its coffers is cash strapped, and therefore they're basically looking at ways of generating revenues. But of course, there's need to strike a balance between revenue generation and also promoting growth within the broader economy. So that has created an environment of uncertainty, policy shifts, and we expect that to continue, especially when you then consider the monetary policy that's going to be announced, I think, in the next 2 weeks or so.
But now tell us how sanctions continue to affect the Zimbabwean economy.
Okay, so when we talk about the political environment, I think, of course, we're coming from elections, but what that means also, or what's important to look at, is how Zimbabwe is positioned for access to capital, access to international partners. I think that has been a major issue, given that Zimbabwe has had to look inside in terms of funding itself. So the issue of sanctions, also put a dent in terms of how Zimbabwe will move forward in terms of access to credit lines and also things such as FDI flows. So there's need for more engagement efforts, especially on the part of the government.
And that's where we leave things for this week's episode of Africa Trade and Business. From me, Bronwyn Seaborn, and the rest of the team, it's goodbye for now.